Good afternoon and welcome to the Accounting and Auditing Update. Today we're going to focus on the 3 new standards that have been issued that are going to impact nonprofits going forward. You can see from our agenda, we'll go through those 3 accounting standards updates. We'll talk about the upcoming roundtables in case you'd like to attend those, and then at the end we'll leave time for questions. You will see right where you downloaded this presentation, you will also see several handouts that you can use. One is a handout of the PowerPoint slides. So if you like to take notes, you may want to go and get those printed before you complete watching this webinar. There is also some other handouts. 2 are informational. One is the summary of the accounting standard updates issued since October 2017. This shows you all of the accounting standards updates that have been issued since our last roundtable relating to the accounting updates. This is mainly just for you to look through, glance through, and see if there's any other of the updates that might impact your entity that we don't talk about today. If you see anything on there that impacts your entity, you might want to talk with your accountant, your auditor, just to make sure if it impacts you or not and when the effective dates are. So that is the handout on the summary of accounting standard updates. And again, that's just for informational purposes only. We won't be referencing that during the webinar. Another one of the handouts is on functional expenses. This document is out here because we've gotten a lot of questions on functional expenses as we've been working through the webinars. Basically, what gets included in your program services, what's included in management in general, and what's included in fundraising. This document here, we've pulled the information directly out of the standard, so you can see the definitions that the FASB has given, and you can then use those to determine where things belong. So if you do have questions on functional expenses, this is a great resource for you to use going forward. The next document that we will be using quite a bit during this session are the examples. So these are example of some of the new footnotes and disclosures that are going to be required as part of the implementation of ASU 2016-14. And that's the update to the nonprofit financial standards. So this document I will be referencing several times during the presentation, asking you to look at those examples for basically to help clarify things, and then just for you to have as you begin trying to implement that standard. So again, the example handout is going to be critical during the presentation today. And then the final handout is the decision tree for ASU 2018-08. This relates to revenue recognition, specifically trying to determine what are contributions, what are going to be exchange transactions. This is a quick snapshot. If you're not sure what to do with a contract going forward, this is a great resource to kind of just walk it through step by step to determine how do you need to account for it under the new ASU 2018-08 standard. So again, I'll walk through this slide by slide, but again, it's just a great resource for you to have going forward after the webinar as you're starting to review your contracts. So let's get started. The 3 main accounting standard updates that we're going to focus on today are financial statements, which is topic 958, revenue recognition, topic 606 and 958, and leases, topic 842. Again, the ASUs that we've issued since October 2017 are included in your handout. So again, read through those to see if there's anything that might be applicable to you and your entity. And if so, reach out to your accountant or auditor so that we can provide you more information and assistance. We are covering these in the order in which they are going to be implemented. So we're going to spend the most time today talking about this new financial statement standard. Revenue recognition is then implemented a year later, and leases is implemented 2 years later. So we'll cover them kind of in the order in which you need to implement them. So the first one is the not-for-profit financial statement standard. This is an update, not an overhaul of the current model. So again, we're not trying to change everything that is in the not-for-profit financial statements. We're just trying to make them better. A few of the key things that you're going to see, we've improved the net asset classification. So we're going basically from 3 classifications down to 2. We're improving the information that's presented in those financial statements about how does the not-for-profit handle their liquidity, cash flows, financial performance, and functional expenses. And then the most important piece is the reason that this has been changed is to better help not-for-profit entities tell their financial story. So when not-for-profits are looking for funding, we really want to be able to have these financial statements help in that process. So help to tell the story of what funding do you currently have? How is that money being spent? How much of that money is going directly to program services versus management in general? What kind of liquidity do you have? Do you have big cash reserves? So again, we just want this information to be more readily available and for it to be consistent from nonprofit to nonprofit so that a funder can look at 2 sets of financial statements and decide which organization they want to provide the funding to. So that's the overall goal of this, and hopefully as we go through the presentation, you'll see how this is increasing the value of the financial statements. So the most critical thing for you to know is that the effective date for the ASU 2016-14, the new financial statements for nonprofits, is effective for fiscal years beginning after 12/15/2017. So in essence, this is for the calendar years ending December 31st, 2018, or fiscal years ending in 2019. So basically, for the majority of you, this needs to be implemented now. So if you are a December 31st year end, this has to be implemented for your December 31st, 2018 financial statements. If you are a March 31st year end or a June 30th year end, this would be effective for your March 31st, 2019 financials or your June 30th, 2019 financials. So this is the standard that is needs to be implemented the soonest, and that's why we're going to start with this one. So the key changes with this accounting standard is changing the net asset classes, as I mentioned. There's a new disclosure requirement on the liquidity and availability of resources. For some entities, there's a new requirement to report functional expenses. There's a new option for the statement of cash flows that we'll go over, and then there's some changes to investment return. So we'll cover each of these bullets in detail, give you more information to help you implement this. So the first one is we're going from the 3 net asset classifications down to 2. So today we have the unrestricted net asset classification, temporarily restricted, and permanently restricted. Going forward, there will be 2 net asset classes, without donor restrictions and with donor restrictions. So on the face of the financial statement, you won't need the 3, you can now go down to the 2. If you look at your example handout, you will see on page 2, they give you a few examples of what this might look like for the statement of financial position. So you'll see there on page 2, it shows you net assets without donor restrictions of $10,567,000, and then net assets with donor restrictions of $3,510,000. Okay, and then they're showing you on the statement of activities, you could do with and without donor restrictions as columns. That would be one option of how you show this. Or you could do the top half of the statement of activities would be without donor restrictions. The bottom half would be with donor restrictions. So there's a couple options there. On page 3, it also shows you, you could go with the basic, just the net assets with and without donor restrictions. Or you could break it out a little bit more on the face of your statement of financial position and show under net assets without donor restrictions, the undesignated and the operating reserve. And then under net assets with donor restrictions, the time restricted for future periods, purpose restricted, endowment fund, etc. So you will be given options as to whether you just want to do the minimum on your statement of financial position, or if you want to give a little bit more detail on the statement of financial position, okay? Either way, going back to the slides now, either way, you will see that there are disclosure requirements regardless. So in the footnotes, disclosure is another word for footnotes, you need to show the composition of net assets with donor or grantor restrictions. So what makes up those numbers? Some of the specific things you need to kind of break out are those that are restricted for a specified purpose. So these funds are restricted for use with the homeless program, or these funds are restricted for use for behavioral health counseling. Those that are restricted for a specific time. So these are funds that are to be used in the 2019 calendar year. These are funds that are to be used in the next 5 years for a capital campaign, something like that. And then the last one is those that are perpetually restricted. So this is your permanently restricted category. So these would be things like endowment funds, where you may be able to use and spend the income off of the endowment fund, but you're not allowed to touch that principal. So even though it doesn't have to be in a separate category or classification anymore, you still are going to need to know the details of the different restrictions so that you can present it in the footnotes. The next item is that you will have to have both quantitative and qualitative information about any board designations. So if your board has chosen to designate certain amounts, like maybe they say every year 10% of the earnings of the not-for-profit are going to be designated for an operating reserve. Maybe they say 500,000 is going to be designated for an upcoming capital campaign. Any of those things that are board designations also need to be specifically disclosed now under this new accounting standard. One of the key things related to that that's in the standard is that it indicates that the not-for-profits must have a policy or a procedure on board designations, even if no designations currently exist. So this is one thing that we feel a lot of nonprofits are not going to have yet, and they need to start working on this and have the board pass a policy that states how exactly does the board go about designating certain items. Is it via a board vote? Is it the board president gets to make the decision? Is it the board treasurer gets to make the decision? Has the board delegated the authority for these designations down to management, someone like the executive director? If the board does not allow designations, that also needs to be listed in the policy. So something just as simple as not-for-profit entity A does not allow board designations. That's as simple as it needs to be, but it will cover off this requirement. The other thing that we recommend that you include in this policy is how do you go about undesignating something? So let's say the board designated 500,000 for a future capital campaign, but something has happened economically, and that money is needed now to keep the non-for-profit going. What is the policy? What is the practice in order to get that money undesignated so it can be used for current expenses? So the key things that you need in this policy is how do you go about designating something? So how do you designate something from your net assets? How would you remove a designation if needed? And then if you don't allow designations, you just have to make sure that that's stated in the policy. So ideally, this policy would be implemented and put in place by December 31st, 2018, or the end of your fiscal year if you are a March 31st or June 30th year-end client. However, if this is not done by then, we would just recommend you get it done as soon as possible. So when you are audited, we can say that, okay, the policy may not have existed at year end, but it has since been implemented. So that is the information related to the board designated net assets. There's also a few other changes that don't relate to many nonprofits, but I want to just point them out. If you have these, I would recommend again that you reach out to your accountant or auditor and have us give you some additional information so that you know how to do these things the correct way. So the first one is that there have been changes to the accounting for underwater endowments. Again, if you have an underwater endowment, you will most likely know about it already. So again, reach out to your accountant or auditor to get those new changes and that new information. The next one is for entities that may have some restrictions on contributions related to capital assets. So this could be contributions for a capital campaign, the construction of a new building, construction of a new homeless center, etc. In the current manner or the current standard, there's a couple options as to how you can release those restrictions. But going forward, they're only going to allow one approach, and that's the placed in service approach. So you will not be able to release those restrictions on capital assets on a capital campaign until the assets are actually placed into service. So I think the best example I could give is with a capital campaign. Let's say your capital campaign is for $5 million and it's a 5-year campaign. You are planning to place the building into service in year 3. So in this instance, even if year 1 and 2 you collected those pledged contributions and they had already been spent to the contractor, architect, etc., you still are not allowed to release those restrictions until the new building is placed into service. So in this example, you would be able to release the restriction in year 3 when the building is placed into service. So this is just going to be a little bit different. And again, it doesn't apply to everyone, but if you are in the process of going through a capital campaign, or people are giving money specifically to purchase assets for your organization, this is something that you want to make sure you talk to your accountant or auditor about so that you have all of the necessary information. All right, so that was the first change on net assets. Now we're going to move on to liquidity and availability. So there are new required disclosures over liquidity and availability. The first one is you must have qualitative information on how your nonprofit entity manages its liquid resources. Specifically, they want to know, how are you managing your liquid resources to meet your cash needs for the next year? Okay, so this is thinking about your general expenditures. So not anything specific to like a capital campaign, but how are you going to meet your general day-to-day expenditures within the next year? So the qualitative part is focusing on how are you managing your resources. So do you put extra cash in a temporary investment or CD? How many weeks or months of expenses do you like to keep on hand in your checking account? Do you have access to a line of credit? Do you have current loans that you're working to pay off? So that's more this qualitative piece. The second part is quantitative, and this is talking about the availability of your financial assets. So this one, we look at the balance sheet as of the balance sheet date, and we determine which financial assets are available today to pay those general expenditures in the next year. So this would be looking at your balance sheet and saying, okay, we have X amount of cash. We have X amount of accounts receivable or pledges receivable that we expect to receive in the next year that we could use to pay this off. We have X amount of short-term investments that we could cash in to pay for our general expenditures in the next year. So there's two key pieces, again, the qualitative piece and the quantitative piece. I think the best way to kind of explain this is to walk through an example disclosure. In this one, they do the quantitative piece first, and then they do the qualitative piece. So I'll work through this with you. I'll stop and explain a few things. But again, I think it's the best way to kind of understand this part. So not-for-profit A has $395,000 of financial assets available within 1 year of the balance sheet date, consisting of cash of $75,000, contributions receivable of $20,000, and short-term investments of $300,000. None of the financial assets are subject to donor or other contractual restrictions that make them unavailable for general expenditure within 1 year of the balance sheet date. The contributions receivable are subject to time restrictions, but will be collected within 1 year. Okay, so that is the end of the quantitative disclosure that they're giving. So again, they're starting with what is the financial assets that they have available. In total, they have $395,000 in financial assets that they can use to pay for their general expenditures for the next year. They then broke that $395,000 down, and they're telling me $75,000 of that is cash, so cash in their checking account. They've got contributions receivable of $20,000. And you'll see in a couple lines later, they told me that it's just restricted by time. So we're just waiting for that, those contributions to come in. So as soon as they come in, we can spend them. And again, they will be collected within 1 year. If you had contributions receivable that were restricted for a capital campaign, those could not be included here because again, they're restricted for a specific purpose, not for general expenditures. So that's just something that's, that you'll need to understand and think about when you look at your contributions receivable. And then the last part was the short-term investments of $300,000. Again, if it was a long-term investment that you could not access within the next year, you would not be able to include it in this part of the footnote. So that, again, it's a simple example, but it's just telling us what do they have available for those general expenditures within 1 year. Okay, now going back, next comes the qualitative portion of the disclosure. So this is how they manage their resources. So not-for-profit A has a goal to maintain financial assets, which consist of cash and short-term investments, on hand to meet 60 days of normal operating expenses, which are on average approximately $275,000. As part of its liquidity management, not-for-profit A invests cash in excess of daily requirements in various short-term investments, including certificate of deposits and short-term treasury instruments. As more fully described in Note XX, not-for-profit A also has committed lines of credit in the amount of $20,000, which it could draw upon in the event of an unanticipated liquidity need. Okay, so that's the qualitative part of the disclosure. So they're telling you what is your process to manage your resources. Okay, so this entity, their goal is to have 60 days of normal operating expenses on hand. So that's what they like to have. That's 2 months. For some nonprofits, that you're not going to be able to have 2 months available on hand. Maybe you're going to have 1 month. Maybe you're going to have 2 weeks. Okay, so it's just saying, what is your goal as an entity? How much do you want to have on hand? And then it talks about, okay, well, what if you do have excess funds? What are you doing with them, right? Do you just leave them in the checking account? Do you move them to a CD? Do you put them in a money market account? So that's kind of that next part. And then again, if you have any lines of credit that you could use in case of an emergency, you're going to want to include that in the disclosure. All right, let's go back to that handout on the examples. And I forgot to mention this before, but all of these examples we actually got from the AICPA 2018 Governmental and Not-for-Profit Training Program. So again, these are examples that the AICPA has put together, and we just thought that they were really good to be used here. So on page 7, this is an example of a liquidity disclosure, a liquidity footnote. This is more the qualitative piece. So again, this is how one organization is explaining how do they manage their liquidity? How do they manage their financial assets to ensure that they can meet those general expenditures in the next year? Okay, so that one's on page 7. Page 8 has a really nice table for you that kind of gives you a breakdown of, well, how exactly should I disclose this information? Should I just have it in a paragraph, similar to the example disclosure I showed you in the slides? Should we use a table? What is going to be the best way to communicate this to our readers? So on this table on page 8 in our example handout, you'll see that if your entity has no complexity regarding its financial assets, when they're available to use, you can generally get away with a text-based disclosure, a paragraph similar to what you saw in the slides. If there's low complexity, so maybe you've got a few restrictions, but they're mostly time restrictions, those sorts of things can also be explained in text. So you wouldn't necessarily need to put a table together or anything of that nature. But if you have moderate to higher complexity, you probably are going to want to include a table. So if you move on to page 10, this will be a very basic example of a table version, again, for an entity with lower complexity. So again, on page 10 in the example handout, you will see here, they're breaking it down, showing you how much cash and cash equivalents you have, accounts receivable, contributions receivable, and investments appropriated for current use. And that gives you the total financial assets available to meet cash needs for general expenditures within 1 year. In this example, these may or may not tie directly to your statement of financial position. So let's say, for example, you've got contributions receivable that aren't going to be received within 1 year. Those would be excluded from that 1,825. Or, for example, let's say you've got contributions receivable that are restricted for a capital campaign. Those would also be excluded. So there's nothing saying for sure that the numbers that you're seeing in this footnote on page 10 would exactly tie to the statement of financial position. These numbers could be adjusted to kind of show the reader which amounts are not available for general expenditure. Okay, so that one is page 10. Now, if you have a more complex entity, we're going to go to page 12 to show you an example of how that would be broken out. Okay, so this would be an example of a moderate to higher complexity entity. And again, they're trying to show us the availability, so the quantitative piece of our disclosure. So here you'll see at the top, they're listing their total financial assets. So how much cash do you have? How much accounts receivable, pledges receivable, investments? So what is your total financial assets? Okay, they take that number and then they say, okay, our total is 14.3 million, but there is some of those amounts that we are not allowed to spend. So for example, receivables scheduled to be collected in more than 1 year, 125,000. Those are then removed from that 14.3 million. Then we've got cash restricted for a specific use. That has to be removed. Your endowment fund has to be removed because again, that's perpetually restricted. You're not allowed to spend that, only spending the interest or income on that. So the actual principal has to be taken out. Here they've added back the amount that they're going to be allowed to spend in the next year. So that's the 547,700. Okay, then you've got some other donor restrictions that they're taking out of there. And then finally at the very bottom, you're going to see they have to remove the board designations. Because if the board has designated it, that means it is not available for general expenditure. So at the end of the day, you'll see what is left for that entity to spend for general expenditures. So one of the things that I'm recommending to a lot of the not-for-profits that we're working with is to do this calculation and see where are you coming out. So do you come out and have positive financial assets available to meet cash needs? Are you coming out and that number is negative? So again, when you're trying to tell your financial story, right, you don't want this number to be too large because funders then might say, well, then why, why should I give you money? You seem to have plenty of money to cover your general expenditures. But at the same time, we don't want it to be negative where a funder would start to be concerned about, well, is this entity even going to be in existence a year from now? So it's kind of a balancing act between how much or how little that you want there. But I would recommend that people look at it because there are a few things that you could do if this is showing, an extreme negative number. You could go through and have the board undesignate some of their designations. So let's say that number, that operating reserve number, was much higher. They could go back and decide, you know what, we're only going to designate 500,000 of it. The rest of it can be used for general expenditures. So there's just some things that could be done to help make this tell your financial story a little bit better. So that's kind of the information that we have specifically related to these disclosures. Moving on to our expenses. The new requirement in this ASU 2016-14 is that all not-for-profits now, not just the health and welfare nonprofits, must present an analysis of expenses by function and nature in one location. So you can't just have it by function in one place and by nature in another place. You have to have those both together. We generally call this the schedule of functional expenses. It could be a statement of functional expenses. And some of you are already doing this today, so you won't see a major change here. For those of you who this may be new, a functional classification, so if I say expenses by function, that means I'm grouping your expenses based on the purpose of the expenditure. So is the purpose for your program services? Is the purpose for management in general, or is the purpose of that expense fundraising? So that's your functional classification. The natural classification is based on that expenditure. What is the economic benefit? Okay, oh, that was a salary. So, you got services provided by the employees. That was an employee benefit. That was a utility. Okay, so functional classifications is your purpose. So program services, management in general, and fundraising. And natural relates to the kind of benefits that you received. So salaries, employee benefits, professional services, etc. One of the newer requirements is you also need to include a description on how you allocated your costs among program, management in general, and fundraising. So again, let's say that you have a building. It includes program services, it includes management staff, it includes accounting staff. How did you go about splitting those building costs to the various functions? So how did you decide how much belongs in program versus management in general versus fundraising? So again, this is going to require that this is included in the footnote so that you explain in more detail exactly how you're allocating the costs. This is then going to hold not-for-profits accountable to not changing their allocation methodology year over year, which will give us some additional consistency in the financial statements. You can see on page 13 of our example document, just one example of how you could explain your allocation methods. So again, this one is a text version, but they're just trying to help you understand how did they go about allocating the building costs, the salary expenses, etc. This is also where that handout on the functional expenses can come in handy. There are a couple examples at the back of that document that give examples of how would you split out costs for a CEO, a CFO, etc. So again, that can just be a good resource to kind of give you some additional information on this allocation process. The other thing about the functional expenses is that there is improved guidance about management and general expenses. So what types of things can be included in management and general expenses. And the next slide gives you some examples. So per the new standard, the following items are always management and general. Okay, so oversight and business management, general record keeping and payroll, your human resources function, so hiring, firing, benefits, etc. Budgeting process all belongs under management and general. Financing costs belongs under management in general. Here there can be some additional allocation done of financing costs. So if you're financing a building that's only being used for program services, there may be some amounts that we can include under program services. So that one's a little bit grayer than the rest. Soliciting funds other than contributions and membership dues. So any kind of expenses you have for soliciting those funds belongs under management in general. Producing and disseminating the annual report. And then administering government, foundation, and similar customer-sponsored contracts, including billing and collecting fees and grant and contract financial reporting. So the ones that we're kind of seeing the most feedback on from not-for-profits, the annual report one, a lot of people were putting that in fundraising because they used that document then to help them raise funds for the next year. So that one always has to go into management in general. And it's the last one here, this administering of these various contracts, including the billing, collecting, etc. A lot of people were including that in program services. So if I'm billing you related to the childcare that I'm providing you, they were including that under their childcare program. But here it's basically saying, really, that's an administrative cost and it belongs under the management and general expenses. The best way that this has been explained to me is basically you need to assume that everything belongs under management in general unless you can prove that it belongs under program or fundraising. So that's where, again, that handout on functional expenses comes in. You will see the definitions of program and you'll see the definitions for fundraising. So if you can use that definition and prove that an item belongs there, then that's perfect and that's where you should allocate it. But if you can't find something that exactly fits the definition, or if you're uncertain, then it needs to remain in management in general. And again, please, please, please feel free to reach out to your accountants or your auditors if you have questions. We want to make sure that we get this right in the first year instead of having to do a lot of cleanup down the road. So again, that's what we have related to our functional expenses. Here is an example in case you've never seen one. Generally what happens with a statement of functional expenses is you'll see the programs and management in general and fundraising. So your functional items go across the top, and then in the rows you'll see your natural classification. So salaries and benefits, rents and utilities, etc. So it basically comes out as a table. This will then need to tie, so in this example, the $260,000 will need to tie to your total expenses on your statement of activities. So we need to make sure that we're including pretty much everything in here. If this amount does not tie exactly, it may be that there are a few exceptions, but in general, most entities, this number will tie exactly to their statement of activities. All right, so that's what we've got for functional. Now we're going to move on to the statement of cash flows. As some of you know, the statement of cash flows can be prepared either using the direct or the indirect method. In the past, if you used the direct method, you also had to show a reconciliation to get from the direct method to the indirect method. So as a result, the majority of not-for-profit entities were using the indirect method so that they didn't have to take that extra step of doing the reconciliation. The FASB would really prefer for entities to be using the direct method. So one way to entice entities to kind of move in that direction is that they have removed the requirement for the indirect reconciliation. So under the new standard, you can still use either the direct or the indirect method, but if you choose the direct method, you will not need to provide that reconciliation. So again, the hope is that some entities will begin to change over from the indirect to the direct method. As a firm at Wegner, we will basically probably continue to use the indirect method unless a client specifically asks us to move to the direct method. So this will be more client-based decision versus kind of what we would recommend. So we'll probably continue with what we're doing today for the client unless they ask us differently to make a change. And then the last major change related to ASU 2016-14 relates to investment return. So the new piece of investment return is now you can net your external and direct internal investment expenses against that investment return. So instead of saying that you had a return of $200,000 in your revenue section and then saying, oh, but we also had investment expenses of $50,000 under the expense section, you can now net that and show $150,000 under your investment return. So, and the change really is the direct internal investment expenses. For most not-for-profits, you do not have a material amount of direct internal investment expenses, so you probably won't make a change relating to this part of the standard. However, if you are a bigger not-for-profit and you do have, you know, a dedicated person or a part-time person who only deals with handling your investments, you may want to look at this more closely and net the expenses of that investment individual with your investment return. And it does make sense if you think about it, right? So your investment return, it's money that you're making on your investments, but if it's also costing you $20,000 a year in order to make the investments, pay the fees, etc., well then your investment return is actually lower. So that's kind of why they're allowing you to net those, okay? The amount of the investment expenses that you're netting, so this external and direct internal, does not have to be disclosed. So you don't have to tell anybody how much those expenses are. You also do not have to disclose the components of the investment return anymore. So you don't have to say this amount is interest, this amount is dividends, this amount was unrealized gains, this amount was realized gains. So you don't have to have that level of detail any longer in the specific footnote related to the investments. It most likely in that level of detail may still be needed for the statement of cash flows. So it will be interesting to kind of see how this plays out as we're implementing this, because a lot of people like to show on the statement of cash flows that this is the investment or the interest and dividend income that came in off of investments, etc. And the last one here is if you did net any investment expenses, you should also exclude that from your expenses by function and nature. So in your statement of functional expenses, you would exclude these investment expenses. And again, the reason that this makes sense is if my total expenses on my statement of functional expenses should tie to total expenses on the statement of activities, well, investment expenses are now netted in the revenue section, so they would not be included in your total expenses on the statement of activities. So therefore, you need to exclude them from the statement of functional expenses. All right, so that's the change related to investment return. Just to reiterate, the effective date for ASU 2016-14, so the changes to the financial statements for not-for-profit entities, it begins fiscal years beginning after 12/15/17. So basically, this will be calendar years ending December 31st, 2018, or fiscal years ending in 2019. Okay, so this is now any of our financial statements that we're going to start working on for our December 31st clients will need to have this new standard implemented. For prior year information, so a lot of not-for-profits like to show 2 years in their financial statements. Basically what the FASB has done is they've provided the option to omit the 2-year presentation, the comparative presentation, for your analysis of expenses by functional and natural classifications, so the statement of functional expenses and the liquidity and availability disclosure. So in the year of implementation, which will be this year, you can choose to just show 1 year on your statement of functional expenses and 1 year in your liquidity and availability disclosure. Okay, the rest of your financial statements could still show 2 years. Some not-for-profit entities may choose just for this year to do a 1 year only financial. So 1 year statement of financial position, 1 year statement of activities, 1 year statement of cash flows. And some may choose to do, comparative, but just do 1 year of the statement of functional expenses and the liquidity and availability disclosure. Okay, in the year of implementation, there are some special footnotes and disclosures that need to be included. I've just provided some examples so that you kind of have an idea of what these are going to look like. So again, in that example handout, you will find these on page 14 and page 15, which are some examples of what those disclosures will need to look like in this transition year, or year of implementation. So again, that's in the example handout, page 14 and 15. So that is everything that we have related to the ASU 2016-14, the update to the not-for-profit financial statement standards. Again, that's the first one that needs to be implemented, so we spent the majority of the time working on that today. But I am going to cover a few higher level items related to revenue recognition and the new lease standard. So revenue recognition, there's 2 different standards that are going to be implemented at the same time. We've got ASU 2014-09, which was called Revenue from Contracts with Customers. And then we have ASU 2018-08, which is in the not-for-profit entities topic, called Clarifying the Scope and the Accounting Guidance for Contributions Received and Contributions Made. Basically what happened here, the FASB issued ASU 2014-09, Revenue from Contracts with Customers, and a lot of not-for-profits were confused at how to implement that standard, mainly because who is the customer when we talk about a not-for-profit entity? Is it the person who's providing the funding? Is it the person who's being served? So there was just a lot of confusion. The FASB was getting a lot of comments and a lot of questions related to this. And so they did some research and they came back and they issued this ASU 2018-08. It was issued in about June of this year. And this is to help clarify, okay, if your funder is not your customer, how exactly do we recognize revenue? So those 2 are going to be implemented together. So ASU 2014-09, the implementation date is for fiscal years beginning after December 15th, 2018. So this is for your calendar year 2019 entities or fiscal years that end in 2020. So this will be 1 year after the financial statement standard. Okay. Early adoption is permitted if an entity feels ready to implement ASU 2014-09. ASU 2018-08 has 2 different implementation dates. It depends on if you're the one receiving the resources or if you're the one providing the resources. So if you're receiving resources from a funding source, you have to apply the standard the same as ASU 2014-09. So it's fiscal years beginning after December 15th, 2018. So that'll be calendar year 2019 entities or fiscal years that are ending in 2020. So again, if you're a resource recipient, you're going to implement this at the same time as you implement ASU 2014-09. The FASB has given an extra year for resource providers. So if you're the one giving resources to an entity, you are given an additional year. So these would be fiscal years beginning after December 15th, 2019, which would be our calendar year 2020, so December 31st, 2020, or fiscal years ending in 2021. So again, just depending on if you're a resource recipient or a resource provider, determines when you have to implement ASU 2018-08. All right, The first thing you need to do under the new standard, well, with the current standard even, is you have to determine if the transaction is an exchange transaction or a contribution. Okay, just for kind of a brief definition, if it's an exchange transaction, there's direct, commensurate, or proportionate value received by the payer. Okay, so if it's an exchange transaction, I give you $10 and you give me a water bottle that costs $10. Okay, so I'm receiving direct, commensurate, or proportionate value to what I gave you. Okay, if it's an exchange transaction, we're going to follow the Topic 606 guidance. Okay, if it's a contribution, no value is directly received by the payer. So if I give you $10 to go towards the American Cancer Society and I get nothing in return, that would be a contribution. One of the key things this ASU does is it makes it clear that value received for the general public or spiritual value received does not count under this part of the standard. So if I'm giving you $10 for cancer research, even though value will be received for the general public, if a cure is found sooner, etc., that cannot be considered direct value to me, the payor. Okay, so that would be considered a contribution. If it's a contribution, we're going to follow the 2018-08 guidance, the new guidance that just came out. You can also have transactions that are both. So there's some but not commensurate value received by the payor. Okay, so in that case, if there's some but not all value received, we need to bifurcate the transaction, so split the transaction in two and record part of it as an exchange and part of it as a contribution. So maybe an example could be a charity walk, right? So the cost to enter the walk is $25. Of that, the value that I'm receiving to participate in the walk for the free t-shirt, etc., maybe is $10. So $10 would be an exchange, and then the remainder of my $25 fee, the $15, would be considered a contribution. So that would be an example where you'd have both an exchange and a contribution in the same transaction. So let's do some examples and see if we can determine if these are exchange or contributions or both. So the city provides a grant of $5,000 to entity ABC to conduct a study on the homelessness patterns in that city. Entity ABC must provide the report data and findings back to the city. The approximate cost of the study is $5,000. So is this an exchange, a contribution, or both? Well, in this case, this is an exchange transaction because the approximate cost of the study is $5,000 and the grant was $5,000. So you've got that direct commensurate value being received by the city. So this is an exchange transaction. The second example, the city pays Church XYZ $500 to host a mayoral debate. The fair value of the rented space is $300. So is this an exchange, a contribution, or both? This is an example of both. So here you'd have an exchange transaction in the amount of $300 for the rented space, and then you'd have a contribution to the church of $200. Okay, so this is our example of both. And then finally, the city provides a soup kitchen with a grant of $5,000 to provide meals for the homeless one night per week. So is this an exchange, contribution, or both? In this example, this is a contribution. Again, the city is the payor. The city is not getting any direct benefit from this $5,000. There is general public benefit, but the city is not getting a direct benefit, and therefore this would be recorded as a contribution. If you can think about this, this is some of the ones that in the past we probably would have considered an exchange transaction. because we felt like, well, there was value provided for the 5,000. So again, under the new accounting standard, we're just saying, okay, but the city doesn't get the value, so this is considered a contribution. All right. So topic 606, we talked about it. This is if the item is considered an exchange. So there's a few key things that we do when it's considered an exchange. The new revenue recognition policy has these 5 steps. First, you identify the contract with the customer. So what exactly is the contract? You identify the performance obligations. So what is each party required to do? You determine the transaction price. Then you allocate the transaction price to the identified performance obligations. So again, if it's one performance obligation, one price, you don't need to allocate anything. But perhaps they're going to pay, maybe there's 3 performance obligations for a total fee of $1,000. You would then need to allocate the transaction price amongst those 3 performance obligations. And then under topic 606, we recognize the revenue when the performance obligation is satisfied. So if in an exchange transaction, you're going to provide me with a TV, that's one of the performance obligations. You're going to come and install the TV, and then you're going to give me a 1-year warranty on the TV. Those could be your 3 performance obligations. You wouldn't be able to recognize the revenue until each of those 3 has been satisfied. So if I take the TV today, you can record the revenue related to the TV sale. Once you've come and installed it, then you can record the revenue for that second performance obligation. And then after the year of warranty, you can record the third performance obligation. So again, the hardest parts under the exchange transaction is going to be allocating that transaction price to those 3 different performance obligations, because again, sometimes you provide things in a lump sum, you bundle your goods, so you kind of have to be able to split that out. And then just making sure that you wait to recognize the revenue until the performance obligation is satisfied. So that's if it's an exchange transaction, okay? Now, if it's a contribution, there's a few more steps that we need to go through. So if it's a contribution, you need to determine if the contribution is conditional or unconditional, okay? Please note, this is not the same as restricted or unrestricted. So, is the contribution conditional or unconditional? There are 2 things that have to be true for a contribution to be conditional, okay? The first is there has to be a right of return or a release of the obligation, okay? So if you give me a contribution and there is something in the contract that says that if I do not spend it within 2019, I must return the funds, that is a right of return. If you've put something in, if there's something in the contract that says, if you have not broken ground by June 30th, 2019, I am not required to pay my pledge. That's a release of the obligation. So the money hasn't been paid yet, so you don't have to pay it back, but I am being released from my obligation. So the first criteria for a contribution to be conditional is a right of return or a release of the obligation. Okay, so if you have that, then you must also have a barrier that must be overcome. Okay, so if it's right of return or release plus a barrier that must be overcome. Some examples of barriers to be overcome, there's a measurable performance related barrier. So for example, you must serve 5,000 meals at the soup kitchen. You must find housing for 25 homeless. You must find employment for 5 veterans. Those are performance-related barriers, okay? Something specific has to be done. The next barrier is where you have limited discretion over the manner in which the activity can be conducted. So if I'm giving you this money, but I tell you, you must operate a soup kitchen, it must be in this location, it must be open from this time to this time, you must serve these type of foods, I am not giving you any discretion over how you're actually operating your soup kitchen. Okay, so again, that is a barrier because I am not really giving you the control over the money. The next one is the limited discretion in how the funds will be spent. So this could be an example where maybe someone gives you $25,000, but they say that with this money, you must hire 2 veterans, or this money must be used to purchase new office furniture, right? So they're not letting you choose how you want to spend the funds. So that would be the limited discretion over how the funds will be spent. And then there can be some other specific agreement stipulations that would be a barrier. So specific things that you must do to meet those requirements. So maybe you get money, but it says in return, you must provide 5 volunteers for these 10 charity events or something of that nature. That would be something that's more a specific agreement stipulation. So again, if the contribution is going to be conditional, you have to have the right of return or release, and you need a barrier that must be overcome. Okay, if it's unconditional, so if there is no right of return or release, you recognize the revenue immediately. So whenever you receive the revenue or you receive the pledge, you're going to recognize it immediately. If it's conditional, so if there is the right of return or release and there is a barrier that must be overcome, you are not allowed to recognize the revenue until the condition has been met or the barrier has been overcome. So, for example, if you are given $100,000 to provide 5,000 meals at a soup kitchen, you're not allowed to recognize that money until you have provided those meals. We do believe that they will allow us to allocate that. So let's say in the first month you provide 1,000 of the 5,000 meals, you should be able to recognize a portion of the contribution, but you will not be able to recognize the full amount of the contribution until you have met the entire barrier. So in the past, this is where this is different. In the past, if it was highly unlikely that you would not meet the barrier or the condition, we were allowed to recognize revenue immediately. So if, in our example, the soup kitchen, well, if normally every year they serve 10,000 meals, so it is very clear that you'll be able to serve 5,000 meals in the current year, we could have recognized that revenue immediately under the old standard. But the new standard says, no, you actually have to meet the barrier before you're allowed to recognize the revenue. So that's kind of where the difference comes in with the conditional contribution. So my biggest caution that I'm seeing where people are getting confused is that being conditional versus unconditional is not the same as without restrictions versus with restrictions. So I can give you my money. I could give you $10,000 for cancer research and not request a right of return. So if you choose not to spend it on cancer research, maybe I didn't write it into the contract that you have to give me my money back, okay? Or maybe someone gave a donation to a church to be used for handbells, but again, there was nothing specific that said, if you don't spend this on handbells, you must return my money, right? So if there's no right of return or release, that's an unconditional contribution. However, those contributions still have a restriction. So in your financials, you would still say, okay, you know, we've got the 10,000 that must be spent on cancer research. We've got the, I can't remember how much I said, that must be spent for handbells. So just because it's unconditional does not mean it's without restriction. So you still have to kind of consider these separately. The conditional versus unconditional tells us when we can record the revenue. The without restrictions versus with restrictions is how do we record that in the financial statements in terms of net assets with donor restrictions or without donor restrictions. All right, then this is where the handout comes in on the decision tree flowchart. So again, this is just helping you as you have a contract to kind of walk through to determine, okay, is it an exchange transaction? Okay, then I apply topic 606. Is it a contribution? Okay, then I got to look and see if it's conditional or unconditional. So this just kind of helps you walk it through. So again, I'd recommend that maybe you print this, you keep it on hand. So as you begin to work on contracts for the future, you can kind of walk through this and see, okay, how would we recognize revenue on this contract in the future? So implementation tips for this one. ASU 2018-08 is being applied on a modified prospective basis. So we're going to look forward. We will apply this to any unrecognized revenue for agreements that are still in place on the effective date. Okay, so again, this was going to be effective for calendar year 2019, so a year from now. So if December 31st, 2019, you have an agreement and you still have some revenue that has not been recognized, you'll have to review the agreement and figure out, do you recognize it at December 31st, 2019 or not, based on our new standard, okay? It will be applied to any new agreements that are entered into after the effective date. So any agreements that you enter into starting 2020, you will need to apply this new standard. We will not be going back and changing prior period results, and we will not be restating anything, so there should be no adjustment to net assets. So again, under this modified perspective, we're going to look at what contracts and agreements are still out there at December 31st, 2019, where there may be revenue that's unrecognized. We will determine if we will recognize it or not based on the new standard, and then we'll use it for new agreements going forward. So we aren't going to go back and say, oh, we need to restate December 31st, 2018 because of this contract. All right, so this is just something for you to keep in mind. So if you're starting on contracts that will still be in place at December 31st, 2019, you want to start thinking about this. How would that revenue be recognized? Is this going to be an issue for us? Should we change any wording in our contract? Okay, so that's kind of what you might need to do in the next year as we're starting to move through the implementation of this standard. So these standards should be considered for any new contract signed that will be in effect December 31st, 2019 or thereafter. Again, if you're a non-calendar year end, March 31st, 2020 or thereafter, June 30th, 2020 or thereafter, you just kind of have to change that date there based on your year end. All right, and the last topic that we're going to cover is the lease standard. So this one is effective for fiscal years beginning after December 15th, 2019. So this is for your calendar year 2020. So your fiscal year ending December 31st, 2020, or fiscal years that are going to end in 2021. So again, this one is 2 years away from implementation. Basically, it is providing a right of use accounting model for both the lessees and the lessors. So it's not necessarily about who owns the assets, it's about the right to use the assets. So that's kind of where the difference comes in this standard. So a lease contract conveys the right to use an asset for a period of time in exchange for consideration. Okay, so if I'm the lessor, I am giving you the right to use the asset as the lessee, and in exchange, you are giving me lease payments. Okay, so I give you the right to use it, you give me lease payments. That's kind of the fundamental of our lease. So the big question always with leases is, do you have to put them on the balance sheet as a lease liability? Do you have to put them on the balance sheet as an asset? So this is how it's going to be determined going forward. So there's two pieces. If you're going to fall under this new standard, there has to be an identified asset and the right to control the use of the asset during the lease term. Okay, so an identified asset means it's explicitly or implicitly specified in the contract. So if you think about like a leased vehicle, they specifically tell you the VIN number of the vehicle normally in that lease agreement. So again, the asset has to be explicitly or implicitly specified. And then the other piece that has to be true is the supplier has no practical ability to substitute the asset, and they would not economically benefit from substituting the asset. So an example, again, using the car, it would be very difficult for them to substitute one car for another car without the person knowing it, right? And most likely, why would I substitute a vehicle unless you're going to give me a newer, nicer vehicle? And then that would not economically benefit the leasing company. So again, you have to have an asset that's explicitly or implicitly specified, and the supplier has no practical ability to substitute and would not economically benefit from substituting the asset. So that's the asset part. And then the right to control the use during the lease term of the asset. So in this case, I have to have decision-making authority over the use of the asset. I have to be able to decide when I'm going to use it, how I'm going to use it, how frequently I'm going to use it. Again, if you use the car example, it's not the car leasing company that tells me how I can use my vehicle. I'm the one deciding. I decide where I'm driving it, when I'm driving it, if I'm going to drive it in the snow, if I'm going to keep it in a garage, etc. So that I do have decision-making authority over the use of the asset. The second part is the ability to obtain substantially all economic benefits from the use of the asset. So again, in the car example, I get all the benefit of driving the vehicle. The leasing company does not get any benefit from me driving the vehicle. In fact, it's the opposite, right? Their value goes down the more I drive the vehicle. So you have to look at who's getting the benefit of actually using that asset. Is it the leasing company or is it the person leasing? So again, if all these four are true, so if again, you've got your two under the identified asset and the two under the right to control, then you are going to have to include that lease on the balance sheet. All right, so on the balance sheet, you would see now a right of use asset. So this is the lessee side. You'd have a right of use asset and a lease liability. Okay. On the income statement, we've got our amortization expense and interest expense, and then cash paid for principal and interest payments on the cash flow statement. If it's an operating lease, you'll just have the single lease expense on the straight line basis and cash paid for lease payments. So really the only difference with the operating lease, before you only used to have the income statement and the cash flow statement impact, you now will have to put it on the books as a right of use asset and a lease liability. All right. On the lessor side, again, the financing lease, they're going to have to record on the balance sheet the net investment in the lease. So again, this would be the revenue that's going to come in minus the expenses of the lease. On the income statement, they'll show the interest income and any profit that they're going to make on the lease. And the cash flow statement would be the cash received for the lease payments. If it's an operating lease on the lessor side, you're going to continue to recognize the underlying asset. Lease income will typically, again, be on the straight line basis, and you'll have cash received for the lease payments for your cash flow statement. So for implementing this standard, again, it's 2 years out, but just some things to be thinking about. They're going to do this on a modified retrospective basis. So again, they are going to look back, but there are going to be several practical expedients that you could elect to apply to make this implementation easier. So again, that's going to be something that you're going to want to talk to with your accountant or your auditor on if you want to elect any of those practical expedients. Lessees will need to record a right of use asset and a lease liability for all operating leases that are still in place on the effective date. So again, the effective date was December 31st, 2020. So any leases that you have as of that date, you would have to record the right of use asset and the lease liability. Okay. It will be applied to new leases that are entered into after the effective date, and it may require a prior period adjustment because, again, you're going to have to go back and put that right of use asset and lease liability on the books as of the effective date, which could impact prior period information. Okay, so that one, again, is modified retrospective. And this standard should be considered for all leases that will be in effect December 31st, 2020 or thereafter. So again, this will be implemented with your financial statements of 2021, but it has to be in place during the year. So the asset has to be on the books during the year. So again, if you're thinking about entering into any long-term leases, you're going to want to consider this specific standard. Just so you know, we've got some upcoming roundtables on some various topics. You can find the information out on our website by looking at our calendar. But if you had questions or concerns related to the new revenue recognition, we are doing a specific roundtable only on that topic for the new accounting standards for grants and contracts. It'll be January for the Madison area and early February for the Milwaukee area. After that one, we'll be doing tips and tricks for reviewing your 990. So if you're an entity that gets a 990 and you're always asked to review it and you're not sure what you should be looking for, this will be the roundtable for you. Madison area will be in mid-April and the Milwaukee area will be in mid-May. And then our next one will be developing high impact grants. So one of the things nonprofits can always use help with is getting funding. And one way to do that is to have a high impact grant. So we'll be covering that topic July in the Madison area and August in the Milwaukee area. So if any of those topics are of interest to you, please keep your eye out on the website or make sure you're signed up for our nonprofit niche email. And then you'll get an email that says, hey, these are our upcoming roundtables with links to register. So if you do have any questions or concerns, I know you can't really do that on a webinar, but please feel free to send me an email or give me a call, and I will happily direct your question to the appropriate person, and we will do our best to help you as you attempt to implement these standards in the next few years. Thanks again, and have a great day.